Our next guest says there is one piece of data that is concerning. Joining us now, Greg Daco, chief economist at EY-Parthenon. Senior economics reporter Steve Liesman is with us as well. Greg, what is that number that has you a little bit on edge?
I think the number that we have to focus on right now is the fact that income growth is slowing. Whether you look at real disposable income growth, currently growing at about a 1% pace relative to about 2.5% to 3% growth for consumer spending, or you look at GDI, gross domestic income, which came out today along with GDP, that was also on the weaker side at only 1.3% growth. That contrasts with the 3% advance of GDP. So we have to be a little bit careful that the underlying momentum in terms of income is actually underperforming relative to GDP growth, and that is a catalyst that may portend to slower growth in the second half of the year.
So, Greg, let me continue with the thought there. Consumer spending growth in this revised GDP number was revised upward. But there are signs, are there not, that consumer spending may be softening just a bit, and we're seeing that in some of the retail company numbers that are coming out.
Yeah, I think you're absolutely right. We're seeing some signs of a slowdown in consumer spending, but it's not a retrenchment. It's nothing to panic about. What we're seeing is essentially a slower pace of growth in terms of consumer spending. And the reason being that when you look at the cost fatigue element, where elevated prices are weighing on consumers' ability to spend, and the still elevated interest rate environment, the combination of these factors is weighing on a greater and greater tranche of the population. It initially weighed more on lower income families. Now it's weighing on median to higher income families. And as these conditions remain in place, high costs and high interest rates, they will continue to erode purchasing power and lead to slower consumer spending growth, especially in an environment where labor market dynamics are gradually softening.
Steve, why don't you react to what Greg has just said? But let's also dive into that GDP revision up to 3%. Obviously, it's a backward-looking number, but it certainly would be consistent with the idea that the Fed may have pulled off that most difficult of monetary things, and that is a soft landing.
Yeah, it seems that way. And I don't know that Gregory would agree, but I think we do want some slowing here. We're at 3%, which is pretty strong for the consumer. Actually, business investment has been an unsung hero of the recent growth that we've had in this country. So you kind of have firing on all cylinders here. And I think the Fed might welcome a little slowing here. This has been the problem with the soft landing all along, Tyler. You see some slowing, and people start to panic that, and I'm not saying Greg is doing so, that, hey, we're going into recession, when in fact this slowing from that higher pace is exactly what we've wanted all along. I would just add one thing that I believe Greg is 100% right that you may have a slowdown in consumer spending. I think one of the keys here, though, is that consumer balance sheets and corporate balance sheets are in pretty good shape. We have had something of a rise in delinquencies, but nothing that's really at recessionary levels at this point. So while this adjustment goes on, it goes on, I guess, on a nominal basis, not on the leverage side of the balance sheet, because so I think there's going to be an adjustment downward, but I think it's going to be orderly. And if the balance sheets are in good shape and employment remains high, you have a come down from the high levels, but that's not necessarily worrisome.
So, Greg, before I turn back to you, Steve, as I said, the 3% number is a backward-looking number to the second quarter. What is the outlook for the current quarter that we are in, and then as we round into the fourth quarter for economic growth, I'm asking?
Boy, I've seen estimates all over the place in the current quarter, Tyler, from 1.5% up to 3%. I got a little interrupted. I should have been prepared while I'm talking. I'll look up the Atlanta Fed GDP now, but I think it was close to 3% the last time I looked, or sorry, 2% the last time I looked, and it is 2%. That's right, as of August 26th. Look, that's trend growth. That's potential growth. All of this, I think, Tyler, is separate from the notion of should the Fed cut. The Fed needs to cut because it's overly restrictive relative to what would be a reasonable neutral rate. It doesn't mean the Fed should be easy. And even if it did 50, perhaps even 100 basis points of cuts, Tyler, I don't believe the Fed would be easy. I believe it would still be restrictive.
Greg, I saw you nodding there, sort of in assent with what Steve just said, that they don't need to cut to stimulate the economy. The economy seems to be okay. I'd like to get your opinion on where it's going to finish the year, how it's going to finish the year, but that it needs to cut to bring rates more into a normalized position so that it is relatively non-restrictive.
Yeah, I mean, to go back to your earlier point about a soft landing, yes, I mean, if you look at the first half of the year, yes, we had a soft landing. We've had a soft landing for a large part of the past year, essentially, because disinflation forces were still very much in play. If you look at what the Fed should be doing, they should be recalibrating monetary policy. We're not talking about slashing rates down to zero to stimulate the economy. I'll give you one point that's interesting. If you look at the June projections from the Fed, they were looking at the end of 2025 at a federal funds rate at 4.1% and inflation at 2.3%. That means a real federal funds rate around 1.7, 1.8. If you look at today's condition, you have a federal funds rate at 5.4, you have inflation around 2.5, 2.6. That puts the real Fed funds rate around 2.8, 2.9. The gap between the two is about 100 to 125 basis points. That's how much the Fed could actually be easing monetary policy, according to its own projections, to neutralize the effect of monetary policy. And as Steve correctly highlighted, this would be the right type of approach to essentially ensure that we maintain that soft landing and that we don't go overboard with an excessively rapid slowing of the labor market, which would weigh on consumers' ability to spend.